financial markets, securities trading is zero sum. We're going to have a war of AIs against each other, trying to erode each other's alpha.
Welcome back to Breakout from Breaking Views, brought to you by PGIM. I'm Peter Thal Larsen, the global editor of Breaking Views, and I'm joined once again this week by Felix Martin. Felix, good to have you back.
Thank you very much, Peter.
Felix, so this week the topic is the topic that's on everyone's lips at the moment in financial markets, which is artificial intelligence, AI. But you've sort of taken, it's moving stock prices and it's affecting companies, and there's a lot of debate about what it's going to mean. But you sort of come at this from a slightly different angle, actually from a sort of an economics angle. Tell us a bit about how you're thinking about it.
That's right, Peter. I mean, everyone is aware of the massive stock market impact of AI at the moment. You know, if you say you've got AI, your market cap can go up by 60 billion in a couple of days. And if you get it wrong and you admit, like the company Chegg did, a big educational material supplier did, that your business is under threat from AI, you can really be trashed. So we know that's going on, and one question is, well, is that justified? Traditional asset pricing models would say, this is all these stock price gyrations, they're just reflecting rational expectations of what's going to happen. Or is there a bit of a bubble going on? So one angle that economics can give you on this, good old behavioral economic stuff, is are investors being totally irrational or irrational? And I think one should watch out for the possibility there's a bit of irrational exuberance going on.
So behavioral economics, just to explain that a little bit, is this sort of idea developed mainly by these two Israeli academics, right, Kahneman and Tversky, which is sort of looking at the limits of human decision making. Is that right?
That's exactly right. Kahneman and Tversky, they came from psychology, but they really caused this big revolution in economics. And the way they did it was by saying, look, the traditional paradigm, which says that human beings are totally rational and always follow their self-interest, that's got to be rejected in favor of us looking at what human beings actually do, which is that we've got all kinds of different foibles and we make all kinds of systematic biases and tend to make mistakes. That's the behavioral economics revolution. And so in this first aspect, which is, what's going on out there in the stock markets, are they valuing this new exciting technology correctly? It's pretty important to remember that that second part, that people can be quite irrational when something new comes along.
Yeah, so that's interesting. And you have this great line in the piece, the quote from Amos Tversky, quite a long time ago, because he died in 1996. So it must be. He said, my colleagues study artificial intelligence, but me, I study natural stupidity. So
that's right.
So there we go.
That's us, I'm afraid.
But then, but there's also other ways of applying some of those insights to the broader question of whether artificial intelligence will actually work or not.
That's exactly right. And I think that's the most interesting part, actually. And that's the second part of what I've covered in this column, which is saying, does behavioral economics has anything to tell us about, the applications where this new technology may work very well and the applications where it might not work so well? Now, no one knows the answer to this at the moment. It's a very new thing. But it's interesting to see that it's clearly got some absolutely incredible applications. The basic idea, and I've tried to put that clearly in this article, the basic thing that AI can do clearly is it can identify patterns in very large data sets and so on in a way which human intuition and traditional statistical analysis simply hasn't been able to do. And one stunning example of that has been in the natural sciences, AlphaFold, which has proved to be incredible at cracking a problem which has bedeviled molecular biology for decades, so-called protein folding. So that's an example of something which can definitely be done. It's a huge advance. But behavioral economics teaches us that when you try and apply these kinds of pattern recognition tools to human systems, things like markets, financial markets, investing is the example I use in the column, things can be a bit more complicated.
Yeah, so talk about some of those things. I mean, you point out the question of sort of sampling problems, right? Sort of selection bias. What does that mean?
That's right. I picked out a couple of examples in this article. They're based from the field of investing. And sampling bias is a really important problem identified by behavioral economists when they were looking at how humans learn. And basically, the problem is that if you learn from a data set which doesn't include all of the things that can happen, and if the kind of data you're looking at, and financial markets are a perfect example of this, are data sets where you have very rare events which can have a massive impact. So, classically stock market prices, you have occasional crashes, but they have a big impact on average returns. So if you learn from a data set which doesn't include these things, and then you spin out your predictions from that, you're liable to underweight these extreme events. It's a classic problem. And the other kind of approach, the alternative approach that you take, is the one advocated very famously by Nassim Taleb, for example. No, you have to start a priori. You impose a distribution to begin with. You say, listen, I'm just going to assume that these extreme events can happen. I'm not going to learn from the data in front of me. And you work like that. That's the techie way of putting it. Simpler investors like you or me, we just think in terms of heuristics, like Benjamin Graham's famous margin of safety. The reason you use the margin of safety is because we don't know what's going to happen, and therefore we go like that. So that's a pretty important lesson about a property of learning from data sets. And there's every reason to think that AI, which is all about learning from data sets and creating predictive models, will have the same kind of problem.
Yeah, and then to sum up, then you also talk about sort of the impact on the fact that we're, particularly in financial markets, we're talking about humans, and you talk about this British economist Charles Goodhart, who back in the 70s identified a famous law, which again could be an issue for the machines as well as the humans.
Yeah, that's exactly right. The famous Goodharts law, and Goodharts law is usually summarized as, if you take any metric and you try and turn it into a target, you try and leverage it for control purposes, it usually turns out to be, it ceases to be a good metric. The statistical relationships break down. And this is all about the fact that in human systems, if people sense that some policy is against their own interests, they tend to try and outsmart it and outgame it, and they change the relationships. And that doesn't happen, of course, in the natural world. Proteins don't do that. They don't sense that they're being controlled. Financial markets, again, the absolute classic, location for this, because financial markets, securities trading is zero sum. My capital gain is unfortunately going to be your capital loss. So whenever anyone identifies some sort of trading rule which generates alpha, using it systematically, everyone else in the market, of course, automatically has an incentive to try and gain that and try and erode that alpha over time. And that's typically what happens. It happens with traditional systematic trading. And again, one can foresee that this is very likely to happen when you apply AI to trying to find these trading rules. We're going to have a war of AIs against each other, trying to erode each other's alpha. So
you heard it here first, the artificial intelligence will still suffer from possible natural stupidity. So, Felix, fascinating. Thank you very much for that. You can read that column on breakingviews.com. And we will be back again soon to talk about some more investment ideas.